In this week's update, AI robots for investing. Is it a good idea? The folly of trading what should be and not what is, and why this rally can continue. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, there's been lots written and discussed in recent times about AI and where it might be taking the financial advice industry. It's a pretty robust debate. I don't think anyone really knows the answers, but certainly lots of people are looking at it and thinking about it. So I thought it was appropriate to just canvass the question, can AI become your financial advisor? And the answer is yes, possibly, but probably mainly no. So let me look at the yes case first. It's definitely a source of information. There's no question about it. And AI is going to become more and more important and more valuable. But it still requires checking, because if you've done anything with respect to AI, it certainly doesn't give you answers that you can have 100% confidence in, unless, of course, you just blindly ignore that possibility. But if you're doing any sort of comparative work, as I have been, then you'll find that most of it does require checking. There's very, very little that I can take on trust at this point in time. Will it be a time saving? Possibly. And again, it's difficult to know because you end up with a higher volume of information. So it's not necessarily an automatic time saving thing. And I think if we were robots with no emotions, then using information generated by AI is a possible pathway forward. But because we're not robots, it really waters that part of it down very significantly. So if we look at the no case, it's the old story of garbage in, garbage out. And I think most investors are probably not going to know for quite some time how to actually work with AI to get the information that they want. Because we still have to value, as investors, we still have to define what it is that we want and the process that suits our lifestyle and our tolerance to volatility and all those sort of psychological issues. And in working with traders and investors for more than 20 years now, I can tell you that the majority of investors still resist the process of thinking about what it is that they want. And I have always struggled to understand that, because it's quite a simple process. But nevertheless, I guess most people don't feel confident in understanding the questions to ask. They just don't know what they don't know. So having AI is all well and good, but you've still got to end up with an outcome that is suitable for you. AI is not going to automatically generate that for you. So you've still got to go through the thinking process yourself. And the most valuable commodity, and again, I've been saying this to new members of our group for years and years, decades, that the most valuable commodity that you can develop is one of confidence. Confidence in the process you use and confidence in your ability to execute it. And again, AI is not going to do that. And the biggest danger that I think investors will face is that if you are using AI extensively and thinking that's providing the valuable answers that you need, then there is a natural inclination just to switch off and not to concentrate and pay attention as much as you should and normally would. And the market and the world is changing so rapidly these days that I don't think anyone can afford to switch off. And then, of course, from time to time, we get sharp corrections like what happened in March and April of this year, or what happened with COVID in 2020, or with the GFC, or whatever it might be. We get sharp corrections and crashes. And then what do? And it's that change of mind once disaster hits that is the biggest downfall for investors, because you might go into a significant correction thinking, oh, I'm fine because AI's got everything in control for me. But when you start to see the losses mount up, that's when people can change their opinion of what they should do. And it's the same reason that well over 90% of traders can't follow 100% mechanical trading systems. Just can't be done because it conflicts with our psychology. And by default, if you're going to follow something like mechanical trading systems or like an AI investing program, then you've got to follow it 100% of the time, even when it's having a major run of outs, as absolutely any approach to the market will have. It will have a period where the results are just negative. And the problem with it is that that sort of following something blindly breeds detachment from the market until it's too late. And then the emotions kick in and it just has to fail periodically. So I've seen it over the decades firsthand, over and over again, and it's just not possible for the vast majority of people's psychology to hand that over to somebody else, to hand that responsibility over to somebody else. So the damage is then often extreme because you haven't been respecting what the market has been telling you. And if you are any kind of student of the market, you'll know that the most immediate feedback that you get is from what the charts are telling you. As the balance shifts between buyers and sellers, who's in control, that is the most valuable feedback that you can get. So AI will never be the easy answer on its own. It just won't be. So for anyone thinking that that will be the future saviour, I would strongly suggest that you think again. It's just not going to work that way. Now let's just have a quick look at what has happened, because it was another very, very positive week. I think it's the 5th or 7th consecutive higher week on the NASDAQ. So things have been running along absolutely sublimely in America. And investors really should be cashing in big time at the moment. This is one of those periods where it's become much simpler than normal to make money because a lot of stocks are going up. And the danger is, of course, that you think you're a genius because you can back a lot of different stocks and make a profit, but things never go up in a straight line. And a lot of people are starting to think about, what about the economy? What about the seasonality? What about these extreme valuations, the this, the that? There's plenty of that happening and people questioning how the US market can keep rising. And at some point, it will come to a conclusion and we'll get a consolidation or we'll get a pullback. Everybody knows that. But understanding the market dynamics, what actually drives prices, is far more important than the fundamentals. And it's a really important thing to understand, because the natural inclination is to think that if the fundamentals are good, then the market will be good. Well, that is not how it works. The peak in the market, either short-term or longer term, will occur when the vast majority of investors are in the market and there is less buyers than sellers. That's what creates the top. And I don't think a lot of investors actually stop to think about that. So when all the naysayers currently that have been missing out on the rally because they're worried about the economy, the time of the year, the valuations, whatever it might be, when they finally give in, roll over and join the crowd, then that's when we're very close to the peak in the market. And it's really as simple as understanding that the market is about a balance between buyers and sellers. And it fluctuates backwards and forwards over different time periods. It's not a whole lot more complicated than that. So it's purely a game of who's controlling the price action. Now, when we look at the issue of valuations at the moment, it's just not an issue for some stocks because their earnings growth rate and their business growth rate and the probability of the future unraveling in a really positive manner is just so strong that for certain stocks, it's just valuation is not an issue, even though the apparent PE might be somewhat high. All right. I don't know what's coming in the US or what's coming in the local market, and I actually work hard not to think about it because it plants seeds in your mind. It gives you a certain perspective that cannot be helpful in terms of objective decision making. You just read the signals from the market on a day-by-day, week-by-week basis, and that's the best thing that you can do. I've got a process that delivers what I want. It manages absolute risk, it manages volatility risk, and it keeps me calm and quietly confident in the process. And that's all I need to know about. I don't need to know what's coming in America or Australia. Yet a lot of people think that if they can somehow figure out what it is that's coming, then they can profit from it. Well, it just doesn't happen that way. The process needs to respond promptly to market conditions as they change. And so the better appreciation you can get of how to read the market fluctuations up and down, then the better investor you will be. Now, as every week, we also advise that you take whatever other financial, legal, or investment advice that you need before taking action on anything in this video. Let's look at American stocks. The S&P was up 1.6% for the week. The Nasdaq did even better and crested 2%. The Russell was up to 0.2% in the end, so not quite as buoyant, but still not looking too badly. There is a 25 basis point cut next week is set at 94%. That's what the CME FedWatch tool is indicating. That doesn't mean it's guaranteed, but I think everyone is going to get a major shock if the Fed doesn't cut by at least 25 basis points next week. And the outlier could even be a 50 basis point cut, which would really fire the market up. I think the first one is mostly priced in, the 25 basis points, but I would severely doubt that 50 basis points is priced in. So a lot of importance around what happens next week in the short term, but that will really only feed through into short-term market reactions. Apart from that, the overall landscape remains pretty positive in America. The US dollar index down slightly, 97.61. The 10-year yield slipped down to 4.06, and the VIX was under 15. So that was the US market. Now, this is the Nasdaq composite for the week. This is a weekly chart, so you can see we've had another very positive week. Yeah, that's a very strong uptrend following the 8-week moving average. If we look at semiconductors, again on a weekly chart, you can see that we've had 3 or 4 weeks of consolidation, and then we got a very strong week and broke out to new all-time highs on the SMH ETF, which tracks that sector. If we look at where the various money flows went on a sector basis in the US, not a lot of change here. XLC still at the top of the tree. Healthcare came off just a little bit, so did energy, but consumer discretionary continues to be very strong. XLF, which is the finance sector, also still going along pretty well, and staples are at the bottom. So this remains a market that is very heavily orientated towards the more aggressive sectors of the market. And if we look at the Australian market for comparison, we've got XSOs, so small caps are now the big consistent outperformer. And if you go back earlier in the quarter, you can see that small caps were very much down near the bottom of the performance ladder, but now they're very much at the top and clearly outperforming other parts of the market. And this has been a long time coming in the Australian market. Just checking in on the currencies. There's DXY, not a lot of movement, but you can see it's in a big picture downtrend, and we've got certainly a short-term downtrend as well. So there's nothing indicating there in the charts that there's any real change in strength for the US dollar, and the Australian dollar is, within reason, is a mirror of that. Now, turning to the Australian market, the Aussie dollar 65.84, so just under 66, and global risk aversion is taking its toll. The trade surplus was around 7.3 billion, but it's really what's happening globally that international money markets are more focused on. There's a support zone at 64.1. The ASX 200 was down 0.1% for the week, albeit to all intents and purposes flat. There are many parts of the ASX 200 that are trading at rich valuations. They've got little margin for error, and that's compounded by the fact that they're stocks that don't tend to have really strong growth to overcome those short-term rich valuations or the absence of a margin for error. So there is still a lot of risk in the ASX 200, to my way of thinking. There are some stocks in there that certainly are good investing prospects, but a lot of my focus remains outside the top 200, and that's where the real performance is. Gold miners were obviously a really bright spot last week, as they have been now for several weeks. And overall, small caps continuing their dominance, which, as I said before, is really quite overdue. Let's take a quick look at the ASX 200, but not very much change there at all. So that's the weekly chart. And we're still holding pretty close to all-time highs over the last few weeks. Now, precious metals, well, where a lot of activity was, gold was up another $50 to 36.42. Translate that to Australian dollars, and it's 54.90. And silver also had an extremely good week and was 42.16 at the close, and closed pretty much near its all-time highs. Oh, sorry, not its all-time highs, but certainly highs of recent years. Now, when we turn to gold stocks, the ASX-listed GDX has really been moving along very, very powerfully over the last few weeks, as we'll see in a minute with the chart. But despite that gain, and it's natural to think that when you get a sudden surge like we've seen, that there isn't a lot more to come in the short term. But contrary to that, I would say that there is a very significant re-rating that is yet to come. The valuations are still very, very appealing in the Australian market for the growth that's on offer now. Most producers are still undervalued because their profits are escalating very, very quickly. The standouts we've been covering in the various services that I run, and there really are quite a large number of very exciting prospects in the Australian market still, despite the gains that we've seen. And one of the reasons that we're seeing such really strong gains, but I feel very confident that there's a lot more to come, is reflected in this chart, which shows the profit margin that is being produced for the Canadian and the US stock exchanges. It was the only chart that I could get that was relevant. But you can see the all-in sustaining costs, which are the blue bars, have been increasing since 2019. So there's a fairly significant increase there from under $1,000 all-in sustaining cost to about $1,500. But if you now look at the gold price has really started to escalate very strongly in the last couple of years. And so the margin between cost and price received is getting very, very large. So that's why you get this amplification. Now, the prices of gold miners, to my mind, has not kept pace with this reality, the reality of rapidly expanding profit margins. So a lot of the best is yet to come. And that's pretty much how you see it in most of the cycles. You see the real escalation in mining stock prices occurs towards the end. So if we look at silver on a weekly chart, you can see is really starting to escalate very, very quickly now. It's accelerating at great pace. If we look at the gold price in US dollars on a weekly chart, again, we've broken out the last 2 weeks, very significant move. The Australian dollar price has also broken out, but is not moving as strongly because it's got the currency weighing it down to a degree. Now, if we look at GDX, and see what the Aussie index has actually been doing, you can see this is a weekly chart again. So we've had 5 of the last 6 weeks have been very strong, and the week that wasn't was almost flat. But despite that, I think the best is still ahead for this sector. So investors have by no means missed out on the opportunity. Turning to other commodities, copper was up just a touch to 4.58. And the majors are clearly backing a very, very bright outlook. And I've been talking about this for 2 years, and it's getting a bit frustrating not necessarily seeing the real zing in the copper market that we're seeing, for instance, in the gold market. But when you look at what the majors are doing, they've obviously got very strong belief. And just in recent days, we've seen the proposed merger between Anglo American and Teck, the large Canadian miner, which is very much about copper. We've also seen the world's second biggest gold miner, Barrick, supposedly putting $1 billion Canadian gold mine up for sale so that they can focus more heavily on copper. So they're making a very concerted vote of confidence for copper. And of course, both BHP and Rio have hardly been backward in talking up the copper story in recent years. So the majors are clearly gearing themselves up for a very, very bright outlook for the copper sector. The only shame of it is in Australia, the pickings are fairly slim. We've really only got the one significant copper producer of any merit. There are a couple of other copper producers, but for varying reasons, I don't particularly like them. And the developers are not really getting the love from the market yet that you would think. So a little bit challenging in the Australian market to get that sort of exposure. From 2026 onwards, the outlook really is exceedingly bullish. But in the short term, there may be some demand concerns, particularly around China, that are probably weighing on things as well. Crude oil, West Texas Intermediate, 62.56. We've got OPEC in the process of or talking about unwinding previous cuts. So that is going to release more oil into the market. China is stockpiling, reportedly. That will be tending to absorb some of that extra supply. But it's always difficult to know what the balance is there. And overall, we've got all these geopolitical risks around Russia and Ukraine, etc., that are really the main concern and what's mainly driving the price in a somewhat unpredictable way. There's the spot copper chart. We've got a bit of a short-term uptrend, but nothing particularly startling there. And there's the crude oil price. So we're trending down in the short term. We're flattish in the medium term, and it's really hard to know exactly where that is going to be going over the next couple of years. Very unpredictable, that market. So wrapping things up, a robust and repeatable plan will get you where you probably want to go. You've got to spend a bit of time thinking about it, perhaps with some guidance in terms of the thinking hierarchy. But it is a relatively quick and simple process to think through that. And if you follow that plan diligently, then it produces consistent profits over time. If it's a good, robust plan, that's the easy bit. Formulating the plan, and through the good times, it will tend to produce good profits. But it's the other times, short term, when losses occur, that things get a bit more problematic for a lot of investors. So it gets down to understanding the market dynamics. Understanding why your process works is essential in these times, because if you don't understand those two things, then it's very hard to have confidence when the market gets a bit shaky in the short term. So whichever way I think about the market, I keep coming back to this concept of you want to do things that help you build confidence over time. Because then when the markets are going as they are at the moment, you can just sit back and enjoy and don't worry too much about it. Portfolio analyst coming this week. How could I not do a gold stock review in terms of both fundamentals and technicals, the way things are running at the moment? So that's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.